You do not want to miss this episode. We're going to talk about business owner tax deductions and tax credits. We've got one of Canada's top accountants to walk us through it. Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell. Joining me today is Christina Wyatt and our good friend Bob Gauvreau from Gauvreau Accounting and Tax Advisory Services. Bob, Christina, how you guys doing today?
I'm doing great, Darren. It's been a day, a day of business owner struggles, to be honest. But we're all used to those. But I'm doing great.
Yeah, I'm doing great too. I'm excited for part 2 in this series with Bob, kind of diving into some more questions that come up more often than not. Now, before we dig into it, I just want to remind everybody, if you're listening on your favorite podcast platform, please make sure that you subscribe and leave that 5-star review. And if you're listening or watching on YouTube, please like, subscribe, and hit that bell button so you always know when new content is coming out. And don't forget to follow us on social media at Control and Compound.
Okay, so in this episode, we're really going to dig into tax credits, tax deductions for business owners. How do we maximize them? How do we pay as little tax as legally possible? And Bob's an expert who works coast to coast. He's got a team of over 100 employees that help small business owners everywhere in Canada, small, medium, large business owners everywhere in Canada. So the goal of this is to really demystify it. Sometimes, accountants and lawyers try to make things complicated. Bob does a really good job of simplifying. So really looking forward to this episode to kind of figure out what we should be doing as business owners.
Yeah, I'm excited for it too. We all see those memes, like it's a write-off, right? It's a write-off. It's all a write-off. So let's demystify that. But let's go right back to the basics. Bob, can you explain the difference between a tax credit and a tax deduction and how both of those things work for everybody?
Yeah, and they are different. And I think, it's important that everybody knows it. And a lot of people would maybe understand the personal side of tax credits versus maybe the business side of tax credits. But the difference really is that a deduction helps reduce your taxable income, right? It's something that specifically comes off from your taxable income number. For example, if you're a business owner, home office expense, advertising, meals and entertainment, rent, dues and subscriptions, those are tax deductions. So we reduce our taxable income from them. A tax credit is somewhat different. It's a credit that comes in fixed form in most parts. And sometimes it actually scales up as we're investing more. And I'll talk about that in a minute. But it really just saves you that exact amount of money. Or it comes right off the tax balance that you have owing. So a tax credit can be more powerful than a deduction. And we definitely don't want to miss out on some of those credits that are available. Deductions are great. Credits tend to be better.
So what would be some common tax credits for business owners?
Yeah, the biggest one that we would think of would be the scientific research and development, the shred claim, where really we get a credit and an incentive for investing in wages and other direct costs associated with creating new products and new innovative ideas. So the government gives us this wonderful credit, which comes at the sophistication of an expanded package and lots of details tied to it. But based on the calculation, it comes back and it's very, very beneficial if we can get access to it. It's a really great incentive that comes back to us. And a lot of times they even write us a check for it, which is even better. Very, very highly audited and reviewed, but very, very beneficial when we can get access to it.
Yeah, so tax credits are definitely you want to utilize those whenever you can. But as a small business owner, how do you qualify? How do you find out about these tax credits? How do you go about getting the tax credits?
Yeah, you know what? It's interesting, and it almost has to be on a case-by-case basis, right? So if you have something that you feel qualifies for a research and development or a shred claim, you should definitely be speaking with a qualified accountant because they can help you decipher whether or not it qualifies or doesn't qualify. And to be honest, depending on the province that you're in, because it's typically a provincial sort of credit, those qualifications tend to change a little bit. But for the most part, if you're creating something and you're putting wages into it and you're innovating something or coming up with a new product or a new solution or even a software or something that didn't exist before, and you're investing time and resources in it, there's going to be an element of those that we compile together, and that helps quantify the tax credit. And I know, Darren, you came on here and you're like, Bob does a really good job at making this simple for everybody. Well, when we get into tax credits, it gets a little bit more complicated, right? And it becomes very specific. But I think the key outcome here for everybody who's listening is that if you feel like you're inventing something or investing in creating something new, talk with someone who is familiar with how these credits work, because you don't want to miss out on the opportunity to get access to them, because they're very rewarding for the work that you do. Because a lot of times, and here's why, right? Like, here's the basis for it. They want to stimulate innovation in our country. And a lot of the people that innovate, a lot of times it doesn't go anywhere, right? Like, it never comes to fruition because it never really becomes marketable, or we never sell it, or maybe the product or the innovation doesn't work. That's okay from a tax credit standpoint. We just want to make sure that we're recovering as much of that innovation and research development wage costs as we possibly can, to help make that investment go a little bit further and maybe help support the next innovation getting off the ground.
Okay, so if we leave shred and we stay on the tax credits, is there any other tax credits that are common for small business owners outside of shred, or is that that's obviously a big one, but for some businesses like mine and Christina's who don't qualify for shred, what other tax credits, or is it time to jump into expenses?
Yeah, no. So let's hop into the maybe most popular ones. But I got to tell you, like, they're pretty specific in where we get them. So specific that I just looked them up, because they don't happen that often unless you're in a particular industry. So, like, there's one for film and television production tax credit. So if you're in that space, right, where if you're filming or you're creating a TV show or a documentary, you get access to resources there. Interactive digital media. I'm not even going to go into the details of what's in there, but if you have interactive digital media, that's, like, consider it where you're creating a platform that can interact with others without you just doing all the work. There's incentives for that. There's labor tax credits for Ontario film and television. That's in Ontario specifically. Animation and special effects. Gasoline tax for auxiliary equipment. In Ontario, this one is a co-op student tax credit, which is good. Sometimes if you're an apprentice, or you're a company that hires apprentices in the trade space, depending on your province and the time, whether they're trying to incentivize more tradespeople or not, that's a really great one for hiring apprentices. I know in Ontario specifically, it's been very lucrative in the past, where we could get upwards of $10,000 per trades apprentice they have to be registered. They have to be going through the school program. Always something that we should be looking into. There's a whole bunch, right? But a lot of them are very, very specific. I would say, the apprenticeships is a big one. If you're in the film space, there's a lot that are available there, and shred is definitely the other big one.
Okay, so that's tax credit. So that's going to apply to a minority of business owners.
Yeah.
Let's talk about business expenses and tax deductions, which are going to qualify, or all business owners are going to qualify for some level of those. So just give us the basics of business expense, what qualifies as a business expense, and then we can get into some details, examples.
Sounds good. And I want to actually maybe just jump into Christina's comment about you just write it off, and the social media handle of you just write it off. I think there's a really good skit, and I think it was on Seinfeld, and right where they were like, oh, well, you know what they do? They just write it off. Do you know what a write-off is? I don't know. Do you? Right? Like, nobody really knows what it is. Even some accountants, when they talk about it, they're like, oh yeah, we'll write that off. You're like, are you actually going to write that off? Like, so really what it means, right, is that it's an allowable deduction that takes away some of the income, and it reduces our business income inside our operations. I like to think of a general guideline before we get into specifics of what those deductions should look like. If you're spending any money inside your business, and by spending this money, you're generating new revenue, or you're satisfying the work that needs to accomplish that revenue, right, or deliver it, it's going to be a deduction inside your business. with a few exceptions, right? Like life insurance tends to not be a deductible tax expense. We want to make sure that we're not deducting it because we don't want it to be taxable when you receive it in the future. So there's areas like that. Meals and entertainment, 50% is deductible, unless you're inviting everyone that works with you and you do it, I think it's 5 times a year. It's 100% deductible. As long as everybody's included, this is a good one. The other big one that I hate that they do this is golf dues. Golf dues are not deductible inside your business. However, this is how we get around that one too. Before we jump into other areas that are more common, golf dues, we still pay for it with our business. Okay. And a lot of people would say, well, it's not tax deductible. That's okay. You know, if we think of our business, we're paying either somewhere around 12, 13%, depends where you are in Canada, upwards of 26% if you're making income, taxable income above 500,000. So our deduction is really saving 12, 13% or 26%. So golf dues, let's just assume it's at 12% for a minute. We're just not saving the tax deduction of 12% of that golf due. Here's the alternative though. If you pull that money, let's say it's $10,000. If you need $10,000 to pay your golf membership and you're going, it's not a business write-off, so we're not going to put it in there. You would have to take about $14,000 out of the business as a dividend. You pay the personal tax on it to get the $10,000 to pay for your golf membership. Instead, we pay the $10,000 from the business. We just don't claim it as a business expense and get the 12 or 26% deduction related to it. It works out much better. It saves us a lot more tax if we put it through. The one caveat is with golf dues, the primary beneficiary of those golf memberships has to be the company. So you really want to be having those business golf rounds, those business lunches. It will promote it being a business related expense, even though it's not tax deductible. And then we hit, the rest of the categories from A to Z. Really anything that you're spending money on inside your business to generate income, advertising, insurance, dues and subscriptions, rent, home office, vehicle, travel, mileage reimbursement, utilities, rent, all of those are all considered business deductions.
So I'm so much better at this. I have a few audits. It's amazing how much better you get at things. Let's talk about the importance of keeping your receipts and strategies and maybe some tips and practices or software or apps. I use an app now. Started using that a number of years ago, and it changed my life where I can track it consistently. And it's, back 20 years ago, it was the old shoebox at the end of the year trying to go through receipts. So I learned the hard way, the importance of keeping receipts. So can you just kind of talk about best practices and what people are doing and any suggestions?
Let me ask you, sir, what software are you using?
I use Dext.
Okay, Dext is great. It's one of the platforms that we use. So there's a bunch of different ways that we could do this. Dext is a great platform. QuickBooks, if you've got a QuickBooks file that you use, QuickBooks Online, the app, if you download it, you can actually take photos inside the app and it will upload right into your bank feed or your credit card feed, which is pretty great. We use other organizing documents like HubDoc. HubDoc is really great. It's essentially an electronic filing cabinet. So the idea of these document managers is that you're just putting digital receipts in there. Now, the requirement for receipts is that you keep them for 7 years. Now, electronic receipts work great because no really CRA auditors are not coming in person anymore, unless you've got a full-blown audit that's happening and they're looking at everything, including your kids' school supplies costs, which really, honestly, like knock on wood here, we've never had that in 16 years. I've never had that sort of full-blown audit happen. We've had HST reviews, and I'm bringing this up to say, what does an audit look like? And if you have one of these filing documents, is that going to help? Absolutely, right? We have the responsibility, and although we sometimes maybe don't practice it in everyday life, but we have the responsibility to keep these receipts. right? And keep them for 7 years. If we can take a photo, put it in the digital filing cabinet, great. What a great spot for it to be. We can sort it if we need to at a later date, or we can match it up in your bookkeeping file right now. Super, super valuable. But when an audit happens, typically what they'll do, and a lot of people maybe misunderstand an audit because a lot of people get like a preliminary review that comes through in their business, and maybe 1 in 10 gets a preliminary review where they're looking at a specific expense category across the country, like professional fees or travel expenses. And what they'll do is they'll say, Darren Mitchell, we are auditing your company for professional dues. Can you please provide all of the receipts in that category? And so what normally happens in that case is if you have 500 receipts in that category, we'll provide a listing of all the transactions, right, from your QuickBooks Online file or whatever bookkeeping you have. And they'll typically say, can you give us the top 10, like the 10 highest valued receipts submitted with all of these 500 transactions? And that typically takes care of everything. Not to say that we don't have a responsibility to keep the other 495 receipts. We do. But typically, they don't ask for all of them. They ask for a nice sample of your largest ones.
I want to circle back a bit to
Yep.
business expenses and kind of going back there, because I know we've got a lot of small business owners that listen to the podcast. And I feel, and I've seen when I've sat down, like we've seen it a lot where business owners miss some of these expenses. Like we see it a lot where corporate business owners aren't using healthcare spending accounts, or they're not putting their medical, like they're not putting their medical benefits through. Those are the two I know about for sure. I see it all the time. But can you kind of shed light on some of the other ones that you're seeing that small business owners might be missing?
100%. And really great insight there, Christina, as well, because I think this is super valuable for everybody. For anyone listening, if you do not have a cloud-based accounting solution that's tracking these things as they're happening, you're missing out on a huge opportunity. And I would say, to Christina's point, where are people missing out on it? When they're not organized and they don't have up-to-date ongoing financial data. And if I can maybe just talk about bookkeeping for 2 seconds, because I feel like the largest percentage of missed expenses are when people don't have accurate bookkeeping records, right? Because they're missing things. So bookkeeping, why is it important? Well, it needs to be up to date. If you're a business owner and you're trying to make financial and strategic decisions based on financial information and it's not up to date, you could be making decisions based on false information. So don't do that. Have it up to date. Number 2, make sure it's accurate. I had a client a few weeks ago in the construction space, super successful business owner, or so it appeared. So I got into his bookkeeping records and he said, my sister does the bookkeeping. She's in every day. It's up to date. I'm like, great. That's awesome. I can see there's up to date information in there, but there appear to be a few holes. So I said, can I get access? Can I take control of your screen for a second? Yep, no problem. No, my sister's so great. I'm like, oh, awesome. I love that for you. I'm so happy you have up-to-date information. I went up to the little reconciliation document and I clicked on it, and it hadn't been reconciled in 12 months. And I'm not sure that they still speak anymore, but I'm pretty sure we're his bookkeeper, not his sister. And that wasn't my intention, right? My intention was to say, look, get your sister to reconcile these, because if you're not reconciling your bookkeeping documents, there could be expenses that are going through that aren't being recognized in your accounting system. And if you're not doing that, you're missing opportunity. That's a huge one, right? So this particular business had about $450,000 of net income, solid. And then we reconciled and he had about $70,000 worth of net income. Substantial change. And that answered his question, where did all my cash go? Why don't I have $400,000 in my cash in my bank account? Well, that's because you're missing all of these expenses. So up to date, accurate, and then understand what they mean, right? Making sure that you have these financial records that you can get access to. You want to know the score of the game to see if you're winning. So back to the idea of bookkeeping. If you have a cloud-based system, it should be linking to your bank account and your credit card. And all those transactions should be coming into your bookkeeping system, which should be allocated on a timely basis and reconciled. 2 key pieces. Now, here's how we do this, okay? So, or maybe here's where mistakes happen. You need, as a business owner, you need a separate business bank account, and you need a separate credit card or 2 or 3 or whatever that looks like, but they need to be completely separate. Do not put your personal items on your credit card for the business, and do not put your business transactions on your personal credit card, because here's what happens. If you are buying items on your personal credit card and no one knows about them because it's not linked and it's your personal card and you never tell anybody, you miss out on these deductions as well. Those would be the major areas, Christina, that we see all the time, where it is super frustrating, because what happens sometimes too is the person who's paying for something on their personal credit card, they come back to us at the end of the year and they go, hey, Bob, you're telling me I made all this money. Where's all my travel expenses? And we go, what do you mean? We reconcile. Like, I'll jump in and I'll look and I'll be like, I don't know, man. We don't make mistakes when it comes to this information. I don't understand. Like, can you show me the receipt? Oh, it's on your personal card, the one that you didn't give us any information for. Right. It's our fault, you know? So like work with your bookkeeper and your accountant too, to make sure that you're organized enough to not let those things happen, because it's so easy to put it on the wrong card, but you have to pay attention. Like, I've got probably 5 or 6 cards in my wallet at any time, whether I'm in the US or whether I'm in Canada, whether it's business, whether it's personal, whether it's Costco, damn Costco card. But having those separate cards allows me to put the transactions where they need to go so I don't miss my expenses.
Well, Bob, not to teach you accounting things, but you can have a Costco online card on your phone now. It's awesome. I stopped carrying that card. Okay, let's talk about the one we get a lot of questions on, or people to talk about a lot, and that's the car. So you're a business owner, and the work truck's one thing. You got heavy equipment or whatever, but you're a regular business owner, and you have a car. Should I own that personally? Should I own it corporately? Should I lease? Should I buy? What are kind of the parameters to look at when a business owner is buying a car?
Here's my favorite answer, and everybody hates it. It depends. It really does. So, you know what? And honestly, Darren, that's the question that we probably get more than any other question ever. And it's maybe got the most, I won't say sophisticated, but complicated answer, because there's so many different things that we need to consider. As a business owner, here's what I would focus on first when it comes to vehicles. Try and get your best cash flow deal for the business. Okay, so I went and bought my most recent vehicle from a friend of mine, owns a Ford dealership. I got a truck, and I think he was expecting that I was just going to pay cash for this thing. As I walked in, and I got the truck, and he's like, okay, so are you just going to pay by check? I'm like, no, if you could just finance this over the longest possible period of time that you could even imagine, that would be great. He goes, why would you do that? I was like, well, so that I can work and pay for the truck at the same time. Like, I'm not going to give last year's money to pay for a truck that I'm using now to earn this income. Like, let me finance it. Instead of giving you $100,000 for this car, I'm going to give you $800 a month. That sounds way better. And then I'm going to generate revenue by driving to see all my clients. And it's going to sort of match how that goes. So first thing I would focus on is cash flow related to it. Finance it, lease it, whatever you want, but look at those finance lease options and say, which one's the best for cash flow? Actually, let's talk about, before I talk about personal or business, let's just talk about the business side and say, here's the 2 options as well and what they look like. So there's finance and lease options. So finance options mean that we buy it, we finance it, we pay it off over a period of time. We get a capital addition that comes into our business. It's restricted if it's a passenger vehicle. So like if you're a contractor and you're using your truck for work, that's okay. It's not restricted. But we're at like $35,000 as a restricted value. You buy a $100,000 car, you get to depreciate $35,000. It's capped, and vehicles are getting higher, and that number's not really getting as high as it needs to go. So that's one area that we want to just keep in the back of our heads for a moment, because there's very clearly an amount that we can't depreciate. The second part is the lease. So I believe $800 and change is our maximum monthly lease deduction. Anything higher than that, we don't get to deduct. So it becomes a non-deductible expense. So we want to keep in mind there. Strategically, financing, you get a faster deduction because we can depreciate it faster, get a larger deduction up front. But over time, it gets lower and lower and lower. And then all of a sudden the lease takes over and it's higher. So you want to consider that as well, upfront deduction versus longer term financing, which one helps with cash flow, financing or leasing. See how complicated this gets? And now we haven't even answered the question yet. So the question was, do we do it personally or through the business? Well, back to personally, right? If we're looking at a vehicle and we decide to do it personally, and I'll talk about why we may or may not want to do that. Again, we want to focus on cash flow first, finance or lease. We want to get the least amount of payment personally, whether it's a finance or a lease, so that whatever amount that we're figuring out is going to be deductible in this business, we want it to be higher than the payment that we're making for it. Okay. So back to whether it should be personal or business. This becomes a little tricky, and it's almost like we need to know what the future holds for this vehicle to really give a specific answer. But this is mine, okay? If you are driving your vehicle for more than 90% business use, and it's not a passenger vehicle, meaning that you're using it for regular business, put it in your business, okay? Put it in there, we'll deduct it, we'll capitalize it, we'll depreciate it over a period of time. And maybe you want to finance it, maybe you want to lease it, whatever way works best for you there. Let's do that way. If you're driving for less than 90%, what happens is if you've got a corporate vehicle and you're driving it for personal use, you get taxed as a taxable benefit for using that business vehicle. And that tax sucks. It is brutal. And it is always going to tax you based on the original cost of the vehicle. So if you buy a $100,000 vehicle and you have to pay a personal use benefit on that, and maybe you can only depreciate $30,000, but you're paying tax on the use of a $100,000 vehicle, that is very costly. And if you own it for 6 or 7 years, you're still paying based on a $100,000 vehicle every single year. That does not work out very well. So if you're under 90%, and it's a passenger vehicle, buy it or lease it personally. And what we want to do is we want to charge mileage back to the corporation at 70, I think it's 70 cents per kilometer right now. So 70 cents per kilometer, every kilometer you drive for business, you get 70 cents back. It can be quite lucrative because if you can imagine 1,000 kilometers a month is $700. You get that deduction in the business. So you're saving tax, and it's a non-taxable allowance to you as an individual. So you're getting that money out tax-free to pay for your lease costs, your insurance, your gas, if you have gas, and all of those associated costs. So I set it up. I'll give you my example. I drive about 2,000 kilometers a month for business use. So I give myself 2,000 kilometers as a reimbursement, $1,400. That pays for all my vehicle expenses. I get the deduction in the business, and I am not subject to a personal use benefit or taxable benefit associated with that vehicle. Business deduction, non-taxable money out of the company to pay for that vehicle. And then I own that vehicle and can sell it down the road, and I don't pay tax on that either. Darren, how did I do? It's more complicated, right?
Well, I want to go back to the intro where I said you explain things in an easy to understand fashion and just redo that part. But no, actually, I did follow that because I remember like years ago when I used to drive a ton, drive 40, 50,000 kilometers a year. Totally made sense then to buy the company personally because of the reimbursement my company was giving me on a tax-free basis. So I guess we got to look at what percent are you going to drive personally or for business? What's the price of the vehicle because of that? If you buy that $35,000 roughly thing, what your plan is with the vehicle at the end. If you have it personally, you own it, you can sell it, and then how many kilometers you drive. Like throw all those variables in, talk to a smart guy in your office, and they'll tell you what to do.
Yeah, and like there's a lot, right? There's a lot in there. Here's what I would say as a default. Again, if you're using the vehicle and it's all for business, it's not a passenger vehicle, it's actually being used in the business, put it in the business, we deduct everything, you're good to go. If it's not, buy it personally and charge mileage. That's the easy default for us. even if you're using a vehicle in your business, it may be more worthwhile to own it personally and charge the mileage, right? We might be able to get more tax-free money out just by using this vehicle a lot in the business. So, that would be always my default. That's the safe answer, the conservative answer, but it also allows us to get that deduction in a good way.
All right, Christina, what do you want to cover next before we wrap up here?
Yeah, just if there's any other, Bob, you got any other tips or things you want to share if a small business owner's listening out there, what they can, I know you've already given a lot of great advice, and I know it wasn't as simple, but it was really good, nevertheless. So anything else that you would want to share that would be important or something that you could look at, take into account?
All right. So as you first started saying anything else, I was like, I gave my good stuff. I actually, as you were saying it though, I got two more for you. Very first, when we're thinking back to, tax credits versus tax deductions, these are going to be tax deduction focused. The very first one is pay your kids, right? So if we've got a business and we've got children who are of age to be doing some work, even minimum wage, put your kids on payroll. Make sure they're doing reasonable work. We got to make our damn kids do some work anyway, And here's why. So if we think of a business, so we talked about the 12% business tax rate for up to 500,000. Anything above 500,000 is at 26%. So let's just assume we're at the 500 plus, okay? Because this will make my numbers look better. If we have a kid who is, 10 years old, we put them on payroll. We pay them $15,000 a year. We're going to get a 26% tax savings on that $15,000 by putting that kid on payroll. Okay. That is a deduction. We get 26% tax savings related to that, which is a really good number. Where I can't even do that math in my head right now. It's been a crazy day, but over $3,000. Okay. And so then what we're going to do is we're going to claim that $15,000 on that child's personal tax return. And because of their personal tax exemptions, they pay zero income, or they pay zero tax related to that, right? Their tax rate is zero under $15,000 with the personal tax credit that they have available to them. So we're saving ultimately $3,000 by doing that. I set up a joint account. I put the money in there for my kids. It's a savings opportunity for them. Hey, you might even want to put it in life insurance. Just, that might be a really good way to get a policy going, They might not even need to know about it. It goes into a joint account with them. The policy is in their name. The premiums come out of that joint account. They now have this high value, probably really low cost because they're young and healthy policy that's just paid automatically out of money they didn't know existed. And you're giving them that asset in the future. Damn, Darren, that's actually really good. I'm smarter than I look.
Yeah.
The next one, right? So get your kids on payroll. Get your spouse on payroll if you have anybody that's at home, that's not working, or lower income levels. Let's start to try and smooth out the income amounts and the discrepancy between partners as well. Obviously, there's, with our tax system, it's marginal rates 0 to 55%. If you're at 55 and your spouse is at 10, let's maybe pay them a little bit and pay you a little bit less. Let's bring yours down and bring theirs up a little bit. That'll save some money as well. The second area that I want to say is this, and I think it ties in, Christina, to your comment earlier about the just write it off. The other one that I get all the time is and sometimes I have clients send me TikTok videos, and they send me the TikTok and they're like, "Can we do this?" Absolutely not. Okay, just because the guy down the street or the marketing guy who says he's a multi-millionaire driving the Ferrari around who has no money at all is doing this in theory doesn't mean that we can do it. Okay. So one of the things that I get asked all the time is, what should we spend money on, Bob, to save tax money? And I usually laugh and say, give it to me. Although we could do a real good tax plan for you. I'll tell you that it'll save you money. But ultimately I kind of make fun of that situation because just don't waste your money. Don't waste your money. If you've got tax that's owing, we're going to be strategic with this. And I'll get there in a second. But what we don't want to do is waste money. If you give me $1,000 to wipe out $1,000 of your income, you have no money left. You gave me your $1,000. I'll take it and I'll pay my 26% tax, and I have $740 in my bank account. I am winning. I will pay the tax all day and keep the rest of the cash. I do not want to spend things on wasteful items just to get a tax deduction. However, let's be strategic. So let's think about timing. If you've got something coming up, I know a lot of people are December year ends. So you're coming up to the end of the year and you want to know, what can we be thinking of to get ourselves a tax deduction? Well, there's a few things. If you have any equipment, vehicles, buildings, capital items that you need to invest in, and you want to do it in March, April, May, think about doing it now. If you do it now, we get access to the deduction in the period that it's taken. So, for example, if you were needing to buy some fleet of vehicles, you can buy them in December. We can start depreciating them in 2024, and they're ready for you in 2025. We get access to a tax deduction now. That's strategic timing, right? That's good. So anything like that, right? Strategic timing is going to be very important. The other one that we need to consider is, if you are obviously you're a business owner listening to this. As a business owner, right, we've got two ways that we can pay ourselves. We can pay ourselves on salary, or we can pay ourselves on dividend. Here's the interesting part of salary, although I'm a heavy advocate for dividends. We can actually pay a bonus out. So if you've got some heavy taxable income and you want to get that income amount down, but you don't want to pay out anything related to it, you just want to get access to a deduction right now and you'll deal with it later, you can pay a bonus to yourself, and it's not payable for 180 days. So you could claim this deduction on December 31st of $100,000, save all the tax associated with it, and then you've got to pay yourself that by July 15th, 2025, and all the source deductions related to it. So you could save money now, save tax now, but you're going to have to pay it later. That's just a deferral opportunity. So I think those would be some of my key tips to end the year and to get and maximize our deductions and our credits.
I love it. Bob, that was informative and quite simple, to be honest. Elementary, really. I mean, it was very informative. But my big takeaways are: you got to be organized. You got to have a cloud-based system. You got to have a smart accountant. You got to have a bookkeeper. The taxes are just so complicated that if you're not an accountant, you can't be even thinking of doing your own taxes. But also, I find a lot of business owners, they started out as a 1 and 2 man shop, and they, their accountant / bookkeeper, Jerry, has, works in the loft above his barn. And, they've always dealt with Jerry for 25 years, but now they're a $10 million revenue company, and Jerry's cost them millions of dollars because they didn't upgrade their accounting services when they upgraded their business. So that would be my kind of key takeaways for me: is talk to someone who knows what they're doing, and the importance of bookkeeping as well as the accounting is what my experience, what made it a lot easier for me.
Absolutely. Completely agree.
All right. Bob, Christina, thanks everyone. That was informative. Look forward to having you back, Bob. Always learn something when I talk to you. Thanks, everybody. Have a great day. Thanks for watching this episode of Control and Compound. Don't forget to subscribe and hit that bell button so you never miss a new episode. And if you're ready to learn more, head to our website, controlandcompound.com. The link's below.